Hello, and welcome to Day 5 of the Milken Institute Global Conference. My name is Mike Piwowar, and I have the pleasure of moderating today's first session with our all-star lineup of panelists to discuss lessons learned from the recent market volatility. For more than a decade, members of Congress and their staff, senior officials in multiple administrations, and the financial regulators, myself included, have sought out the insights of each of our panelists following important market events. We are so fortunate that they could join us as a group today to discuss this important topic. While the five of us could certainly fill the next hour and longer, we will leave time for questions from the audience. So please submit your questions online at any time during our session. Our first panelist is Stephen Berger, Global Head of Government Affairs at Citadel. Next, I'm pleased to welcome Jeff Dinwoodie. Jeff was recently named the Principal Deputy Assistant Secretary for Financial Institutions at the Treasury Department. And prior to that, he served as Chief Counsel to SEC Chairman Jay Clayton. I'm also delighted to welcome Darrell Duffie, the Adams Distinguished Professor of Management and Professor of Finance at the Stanford University Graduate School of Business. And last but certainly not least, I'm very happy to welcome Barbara Novick, Vice Chairman at BlackRock. Now, to set the stage for our discussion, I'd like to remind everyone what the world was like in February and March. As the coronavirus spread throughout the world, there were many unknowns about the health effects of the virus. How does it spread? How contagious is it? How fatal is it? Are public health systems adequately prepared? And there were also very many unknowns about the resulting economic effect. How long would government-imposed travel bans and lockdowns last? What would be the size and composition of fiscal stimulus? How would central banks and financial regulators react? The markets themselves reflected these concerns, fears, and uncertainties. In equity markets, for example, the Dow Jones Industrial Average and the NASDAQ Composite both dropped by more than 30%. The VIX Volatility Index, the so-called fear gauge of Wall Street, which tracks the implied volatility of S&P 500 stock, jumped from a level of less than 20 to more than 80, the highest level since the global financial crisis. Market-wide circuit breakers put in place after the 1987 crash to temporarily halt trading after large market drops, and tripped only one time previously, were tripped 4 times in March. In other markets, many bond funds and bond ETFs experienced large price dislocations between their market prices and their net asset value. The Federal Reserve returned to its global financial crisis playbook and opened several facilities to support strained credit markets, including commercial paper, asset-backed security, corporate bonds, and municipal bonds. In April, the price of West Texas Intermediate crude oil futures collapsed from $18 a barrel to negative $37. Now, with that quick reminder, let's get on with our discussion today. So my first question to the panelists, and I'd like to start with Darrell and then go to Barbara on this one, was I mentioned the global financial crisis and started thinking about how the COVID-19 crisis compares to that. So Darrell, how are these two crises similar and how are they different?
Thanks so much, Mike. It's really a pleasure to be here and be part of this fantastic panel on this topic. Well, going back to 2008, we had a much different kind of a crisis. We had a moderate macro shock beginning in the U.S. housing market that was amplified into an enormous financial crisis with a recession following. And that amplification was caused mainly by fragilities in the largest U.S. banks and securities dealers. In this pandemic, in the COVID pandemic, especially in March of this year, we had a much bigger macro shock affecting almost all sectors of the U.S. economy, causing almost instant massive unemployment. And as you pointed out, very big responses in financial markets. The banks and security dealers were not, in this case, an amplifier of that crisis. Post 2008 regulation made those firms much stronger and more resilient, and prevented them from causing much deeper problems. Of course, the flip side of that safety and soundness of those financial institutions is that financial markets responded much differently. The bond markets in particular were simply unable to process the huge demands for liquidity because the banks are now required to be safe. They didn't want to expand their balance sheets to absorb those massive flows. And as a result, the Treasury market in particular became quite dysfunctional. In the 2008 crisis, the Treasury market was a real source of safety. Investors were able to go there and the market functioned very well. But in March of this year, the Fed had to rescue the Treasury market from dysfunction, which it's never done before in a crisis of this type. So while both crises were very, very severe in their effects on the economy, the mechanisms by which that happened were quite different in my view.
Barbara, anything to add to that?
So I would frame it a little bit differently. When you look at 2008, you had very poor underwriting standards, you had excessive leverage throughout the system, and you had, in some cases, even fraud. I mean, think back, Madoff was only 10, 15 years ago. This crisis really did not start in any way in the financial system. This was a healthcare crisis. Then you had the shutting down of all these economies, leading, as Darrell said, unemployment, a lot of uncertainty about the future of different companies, not just at an idiosyncratic level, but really whole sectors, uncertainty. Remember, we also had the oil shock right at the beginning of the crisis, where it was literally negative prices for oil. I don't think we've ever seen that before. When you look at the two, I would summarize the first one as primarily a credit crisis starting in the financial system and then propagating out to the real economy, whereas this crisis has been more of a real economy crisis coming into the financial system and creating this dash for cash. When there's so much uncertainty, people want to have liquidity, whether it's individuals going to their bank and taking out cash, or it's institutions drawing lines of credit, trying to liquefy their balance sheet so that they can withstand whatever the storm is. And certainly in March, we had no idea how long this was going to be or how deep this was going to go. So I think when you look at the two, the liquidity versus the credit, and as Darrell said, the Treasury market being not liquid, we've never seen that before. But here we saw it in treasuries, then it propagated out to commercial paper and to other parts of the fixed income sector. And it does come to some ideas for the future that involve market structure changes that I think are pretty important given what the bank regulation looks like today. And we can talk about that a little bit more later.
Sure. Yeah, I'd love to follow up on that. But right now, I'd like to bring in Stephen and Jeff into the conversation. Right. So Darrell and Barbara have both mentioned that the banks are much safer now than they were during the global financial crisis, and there have been some other changes since then. So Stephen, let me start with you. After the global financial crisis, there were a number of reforms that were put in place. Dodd-Frank, Basel regulations, the SEC did a number of regulatory things. In terms of the response to the global financial crisis, what do you think, in terms of reforms, which of those do you think actually put the financial system on a safer footing given the current crisis? And were there any unintended consequences from some of those reforms that may have exacerbated the problem?
Thanks, Mike. So, one of the key post-financial crisis reforms that we saw was the reform of our OTC derivatives markets. So those markets were a central source of contagion in the last financial crisis. And since that time, we've implemented central clearing, we've implemented real-time public reporting, we've moved trading onto electronic trading venues. And those reforms have made those markets not just safer and more resilient, but also more competitive and efficient. And so we've seen a lot of innovation happen in those markets, and that has led to better pricing, bid-ask spreads coming in over 50%, firm, immediately accessible pricing being available for investors, and liquidity being more resilient in those markets. And I think those benefits, I think, have been well established, but they were never battle tested in a time of stress. And so If we compare how those markets would have performed if we had still had the 2008 market structure in place compared to what we had in March, it's a world of difference. And so in March of this year, 75 trillion of interest rate swaps were cleared just in March alone. On swap execution facilities, the new trading venues for interest rate swaps, Tradeweb, one of the leading venues, saw 265 billion in daily volume during March, and Bloomberg saw similar volumes. And one of the keys there is that we put in place an infrastructure for that marketplace with straight-through processing. So investors could do a trade on Bloomberg and Tradeweb and know with certainty within a matter of seconds that it was going to be cleared at a CCP like LCH or CME. And so when you're in an environment where you're shifting from being in the office to working from home, the fact that you could still reliably transfer risk, hedge risk through the interest rate swap market, through the credit default swap market, and know you were still clicking a button and having a clear trade with no counter credit risk at a CCP, that was an amazing improvement over where we were just a decade ago.
Yeah, I totally agree with you on the over-the-counter derivatives market and the reforms that were put in place by Title VII of Dodd-Frank. You know, it's hard to imagine, but thinking back to the global financial crisis, right? Financial regulators were actually prohibited by law from actually collecting information on the OTC derivatives market, right? And the notional amounts were literally in the trillions of dollars. And that's where most of the counterparty exposure was during the global financial crisis. And so, you know, looking at SEC disclosures and bank call reports and those other things really didn't give you a true measure of the counterparty risk. And I think even just the regulatory reporting, the regulatory transparency was huge. And then you mentioned, you know, in addition, the clearing and the trading and the straight-through processing, it's also made that market more efficient. Jeff, any other areas where you think that you know, reforms post global financial crisis are particularly helpful?
And thanks for having me, Mike, by the way. I've got a couple that I think are worth mentioning. Darrell and Barbara talked a bit about banking. I think in some ways you have to start there. Look, the regulatory framework that has been put into place following the 2008 crisis around banks, that has really served us well during this pandemic. Vice Chair Quarles has pointed out that in a number of recent speeches that large U.S. banks entered this year with much stronger balance sheets than they had in 2008. And this is a result of the work around capital, new capital requirements, capital buffer on top of the requirements, stress testing requirements. So, you know, banks served as a source of strength to the system this time around. Those are in large part due to the measures put in place since 2008 with certain refinements that have happened over the last couple of years. Secondly, I'll say another sort of bucket that I think is sometimes overlooked is an overall increase in focus on operational resiliency, both at financial institutions and across financial infrastructure. This, you know, in some ways it stemmed from Dodd-Frank with mandatory clearing, Title VIII, et cetera. But it's a result of you know, regulatory response to the 2010 flash crash, Superstorm Sandy, a number of other high-profile outages and market disruptions really focused the mind, both I think in the industry and in the regulatory community. On the banking side, there's been an increased supervisory focus on BCPs, resiliency, cyber, and then on the market side, you know, you can tick through, and you guys have touched on them. You know, at the SEC regulation, SCI, enhanced supervisory standards and regulatory standards put in place by the CFTC and SEC for clearinghouses. And then, you know, a lot of good work has been done around tightening market-wide circuit breakers, you know, replacing single stock circuit breakers with a limit up and down mechanism that is in some ways recalibrated. All of this, I think, has served us well in terms of the pipes and plumbing of the system functioned well during 2020. I'll give you one more, Mike, that I was just thinking about yesterday in anticipation of this call. I think another reform is the establishment of formal regulatory coordinating bodies. And so there's an obvious point, but then a more subtle point that I want to make. The obvious point is, look, the establishment of FSOC through Dodd-Frank and, back in 1988, the President's Working Group on Financial Markets, those have served as well, functioning as key channels for information sharing and coordination. That's a somewhat obvious point. I think the more subtle point, that is a personal point, is that FSOC over the years and the 10 years it's been in existence, it's really facilitated strong working relationships and a sort of connective tissue amongst the alphabet soup of regulators in the community. If you think about FSOC as a pyramid, you have the principals, the deputy level, then the staff subcommittee. All of those, the principals are going to be, of course, meeting regularly during a crisis. The deputies and staff, the years and years of meetings, monthly, biweekly, et cetera, have really established tight working relationships across the agencies, which I think really served us well during this period.
Yeah, I would agree with you. The amount of coordination that I saw among the regulators pre-Dodd-Frank and post-Dodd-Frank it's like night and day. It's unbelievable the amount of coordination that's going on there. So Barbara, BlackRock is subject to regulation from a number of the alphabet soup of fragmented regulators in the United States. What post-crisis reforms do you think work well, and also are there any that have any unintended consequences? And then Darrell, after Barbara's done, I want to get back to you about some of the unintended consequences.
So first of all, I would echo a lot of what other people said. Jeff's point on the coordination across regulators, it was really quite stunning in March how closely connected the SEC, the Treasury, the Fed were. And I think that worked to the benefit of everyone. They were also very much interested in getting the market color from market participants and sharing that information. So there was a very real-time aspect to their actions, and I think that made it much more effective than if it was simply a bunch of disparate programs. I would also echo what you said, Mike, about the reporting. If you think about 2008, lots of questions were asked, from everything from who's using a lot of leverage, who has swaps or how much swaps are outstanding, who are the counterparties, you name the question. And the answer was, that's a great question, but we don't know. And today, there is huge amounts of data that's being collected, that's being analyzed, that is available, certainly to regulators, but in many cases also in the public domain. So there's a sea change in that regard. Now, in terms of what things worked well, I think in the asset management space, certainly the liquidity risk management rule made a big difference. Everybody has a liquidity risk management program in place. I think Jeff mentioned operational resilience. The SEC restated their guidance or reissued their guidance. I think everybody is very attuned to those kinds of things. Where things went a little bit wrong, I would say two issues. One is in money market funds. The 30% liquidity was a great idea, and it certainly made sure that people were running portfolios, high credit quality, short maturities, better liquidity, all those things great. But because it was tied to, if you get to 30%, you have to call a board meeting, they have to make a decision. The decision might be stay the course, but investors didn't like the uncertainty. And so you never got to test if you could use your 30%. So you have 30% liquidity, but you can't use it. That doesn't make a lot of sense. So I think revisiting that, decoupling those two features would be a very important thing. And then also in the liquidity risk management rule, although there was a provision making it legal to use swing pricing in the United States, and swing pricing is simply, think of it as a bid-ask spread at the fund level. So rather than one NAV, people come in or out at different prices if there is a dislocation in the market. And the bottom line is it puts the transaction costs on the transacting investors. This is something that we use all the time in Europe, not just during a crisis, but it's a regular feature of our funds. And we're not the only ones. In the US, although it's legal, there's no way of operationalizing it. So this is a classic problem of commons, where you need a regulatory mandate to get the whole ecosystem to move. It would be like saying, I'm at T+5, I want to go to T+2, and one firm's going to do it, but another's not. Well, of course, that wouldn't work. So this is the same kind of problem. To get swing pricing to actually work would require a whole lot of changes throughout the ecosystem. And short of that, there are other anti-dilution mechanisms, but I do think it's important to look at putting something of that sort into the U.S. Fund industry and make it operational.
Yeah, so I can remember when the SEC, when we were considering the various liquidity management rules, and Barbara, you and BlackRock and others came in and talked about swing pricing. It's very intriguing, right? To your point, when people leave the fund, the manager has to engage in transactions, and those impose costs, but those costs are currently borne by the shareholders who stay in the fund, not the ones that are imposing the costs. And it creates an externality on the fund, and swing pricing is a way to internalize that externality, to use the language of economists. So with that, let me turn to one of our foremost economists, financial economists in the United States, Darrell. You mentioned the fact that in some of these markets, in the Treasury market, and some of these other markets, we were facing strains. I mentioned, the Fed came in with the Fed facilities again to try to keep these markets open. That suggests that things may not be so great in some of these cases. And you alluded to the fact that banks aren't taking some of as much risk on their balance sheet for these, and some of these are regulatory reasons, right? Are you referring to things like Basel and the Dodd-Frank rule? And can you give us some more on that?
Sure. Yeah, I mean, both Barbara and I mentioned that the banks were a source of strength to the economy in March of this year when the pandemic hit. And the reason for that is much stronger bank capital requirements and liquidity requirements. But those same requirements provided incentives for banks to avoid expanding their balance sheets to absorb those huge flows of demands for liquidity, the dash for cash that Barbara mentioned. At the same time, new failure resolution rules brought in with the Basel process made it possible to resolve large bank failures without government capital being thrown at it, which made creditors are now much more aware that they could, in principle, lose money. And whether you believe or don't believe that the government would actually hit the failure resolution button, or whether it would work if they did, creditors have gotten the message, and funding costs for the largest banks are much higher. And so they just don't expand their balance sheets at a moment's notice like they did before 2008. Leading up to 2008, over the previous 10 years, bank balance sheets tripled in size. They would, for a few basis points of profit, they would expand their balance sheets at a moment's notice. But since 2009, bank balance sheets have hardly grown at all. And as Fed Vice Chair Quarles said here at Stanford this week, he doesn't think that the current market structure that's so reliant on liquidity is up to the task of managing demands for liquidity in the huge and growing fast Treasury market. So those regulations, don't get me wrong, would not back away from the failure resolution regulations and strong bank capital requirements. But the unintended consequence is that our market structure is now unable to deal with huge surges of demands in our bond markets. That was shown so vividly in March. And so I would recommend that rather than backing away from those, you just address the market structure directly. Stephen mentioned a moment ago the success in the Dodd-Frank Act of central clearing. If that were brought into the US Treasury market, that would both make more efficient use of the available balance sheet space there is at the largest banks. And in principle, it would allow all-to-all trade, by which investors wouldn't have to sell their treasuries directly to a dealer. They could, in principle, sell them on a trade platform to another buy-side investor without jamming the pipeline of dealer balance sheet space. So I think that's where we ought to turn next.
So lessons learned from Title VII of Dodd-Frank in the derivatives market have direct implications for the Treasury market, is what you're saying. Jeff, let me go to you on this, right? So you mentioned the fact that one of the more important aspects of the after global financial crisis was the fact that regulators are now working together. And Darrell has mentioned multiple times about the Treasury market, being the market structure change. It's an odd market in that there's not one, there's not two, there's actually three different regulators in the U.S. that kind of sort of have regulatory authority over the Treasury market. And part of my concern was that, if you got three kind of regulators all regulating the market, that none of them are spending the intended amount of time on it. Can you talk a little bit about what's going on at Treasury and among the regulators, looking at the Treasury market, and what kinds of things that are they looking to change in the market structure?
Sure, and I'll make the point you made even stronger. And there's more than three. There's throw in FINRA, throw in the banking regulators, throw in the CFTC, so it even becomes more complicated. There's been a couple developments that I think are worth flagging that show both excellent coordination and progress in regulating this market. The first is, Trace for Treasuries, which has been a huge success, which essentially is using a reporting regime in place that FINRA has put in place, and using that to facilitate Treasuries reporting. That's been a big success for two reasons initially. One, it has allowed a long-awaited view into what's going on into the Treasury market. And secondly, a related point, it's actually enabling better regulation, thinking about next steps. And I'll talk about in a second the idea around applying new regulation to some of the trading platforms, and in addition, potentially exploring some of the ideas that Darrell just mentioned. I think Trace for Treasuries facilitates all of that and just makes us better regulators. I touched on it a second ago. The SEC put out a proposal in the last couple of days about essentially applying regulation to platforms that trade only government securities. Just by way of background, today those platforms are not subject to exchange regulation requirements, and they're also not subject to the lighter touch set of requirements that apply to ATSs. The SEC has put out a proposal in which they coordinated with Treasury staff, a very thoughtful proposal that would essentially extend a lot of the key transparency and let's call them systems integrity requirements to these types of platforms. So just in a nutshell, it seeks to subject these types of platforms to Reg ATS, which means that there would be, among other things, public disclosure requirements around things like conflicts of interest between the operator of the platform and other business lines in respect of its customers, and also provisions around protection of confidential customer information. So very common sense and important set of regulatory requirements. The other big thing I think that's worth flagging is they also propose to subject these types of platforms to SEC regulation, SCI, which again, thinking about operational resiliency, SCI is a package of systems integrity requirements, BCP requirements to notify the SEC and customers when there's disruptions, annual review requirements. So I think a very thoughtful and a good positive step towards applying sensible regulation in this market. I'll pause there, Mike, and go back to you.
Yeah, thanks, Jeff. Let me turn to Stephen now, right? So beyond the Treasury market, Citadel, you all operate in a number of different markets with a number of different hats on buy side, market making, various things. Other than the Treasury market, are there other markets that were concerning to you given the volatility in March, and also given the fact that you all were very big proponents, as I mentioned, for central clearing and trade reporting in the over-the-counter swaps markets? Are you identifying new markets where new market structure changes need to be made?
Well, first, I'd like to actually pick up on the Treasury market point, and then I'll turn to your question, because I think that the focus on Treasury market structure modernization here is key. This is a market that has quadrupled in size since 2008, from 5 trillion outstanding to 20 trillion outstanding. It's only projected to grow even further. The mix of participants, both in the primary auctions and in the secondary markets, has evolved substantially. But the market structure, as others have noted, has largely remained the same. And one of the things that really jumped out in March is that it wasn't just hard to sell, it was hard to buy. So if the vanguards of the world are telling you it's hard to even buy treasuries in the dislocations that happened in March, that tells you we need to take steps to make it easier for a wider variety of market participants to fully participate in this market. And so I think a few of those key reforms have been touched on already, but we don't have real-time public reporting in the US Treasury market like we do in equities, futures, options, corporate bonds, swaps. And so Jeff helpfully mentioned that we have the trace reporting architecture in place now for the US Treasury market, but the data that's being collected since July of 2017 isn't being disseminated yet to the investing public. And so if we put that information in the hands of investors, if we remove information asymmetries that exist in that marketplace and provide folks with the confidence that they know what's happening in the marketplace, that market is going to be more resilient in future waves of strain. And Darrell's helpfully noted that we don't have a central clearing infrastructure in the US Treasury market that is truly accessible to all types of market participants. And so that's true for both cash treasuries as well as for Treasury repos, which are an equally core part of making sure that market operates efficiently. And then Jeff also helpfully noted that we're taking steps to rationalize the oversight of Treasury trading venues. So I think this Treasury market structure modernization effort is key, and it will ensure that the system can more effectively in the future handle large selling events or whatever it may be, which otherwise can cause dislocations. Now, if we take a step back, let's look at kind of, what is how did U.S. capital markets perform overall in March? And overall, U.S. capital markets performed admirably. This was a story of resilience in the face of, significant, need to establish new equilibrium pricing, processing record trading volumes. But what it was is the forward-looking reforms that we put in place, coupled with technological investment and automation that allowed those markets to be resilient. And so in the equities markets, in the futures markets, in the options markets, in the swaps markets, where we've made those investments, those markets turned out to be resilient in the face of the dislocations of March. And markets that I say are still where we haven't modernized market structure, where they're still too manual, too voice-based, those markets, will really challenge. And so I think that's the lesson learned, that when we can take steps to both further invest in technology and the automation of markets, and where we can take steps to put in place forward-looking regulatory reforms that modernize the market structure, that's the key to long-term success.
Yeah, Barbara, so Stephen made a good point that the equity markets seem to work very well, or very resilient. Like your perspective on that, and in particular, one of the areas that I noted in the introduction that people talk about that possibly where the capital markets aren't working well, where the dislocation in prices between the market prices for bond ETFs and bond open-end bond funds and their net asset values. And some would say that one narrative is that, well, these are not appropriate products for illiquid securities to be in. I know you have a different view on that, so please share with me.
Okay, so if we can unpack that just a little bit. First thing is, equity markets did go through a lot of changes, a lot of them technical changes we saw after the various flash crashes, and that included things at the exchange level, things at the SEC regulations, even things at the broker-dealers. And those all were done over the period of a number of years. And I think when we look at the equity markets, the big learning is they were volatile, but they weren't broken. Now I want to switch that to the ETFs. So market structure, we've just talked about how market structure today in fixed income in general, not just treasuries, but all fixed income, is not really fit for purpose. That's where ETFs come in. ETFs, by their very nature, the E stands for exchange, they do not require a bank balance sheet. So what we saw in this crisis is, I call it ETFs were the heroes, not the villains, right? They provided liquidity, spike in volume, enormous spike in volume, as we've seen in prior crises. And that meant people could get in and out if they, had a view in terms of asset allocation. They also provided price discovery. So you look at the discounts and you can look at them and say, oh my, something seems broken. But actually what we saw was the ETFs were leading the market and showing where prices were for bonds that underneath, because of the OTC aspect of the markets, were just not trading. And this was, I think, a very important aspect of market structure and the ability to know where these should be trading. And third is that they did this all at a very efficient cost. So when you look at the bid-ask spreads on the underlying market, one of the challenges was they just blew out, whereas exchange-traded products were trading at very efficient bid-ask spreads. So again, I think there are some other narratives out there, but unfortunately, the data doesn't really substantiate those narratives. When you look at the actual results, I think people were very, very pleased with how the ETFs performed and the positive attributes of how they contributed in the crisis, rather than taking liquidity out of the market.
Yeah, Stephen, let me go back to you. So as Barbara said, the equity markets were volatile but not broken, right? Despite the fact that there were calls for some to close the markets or to ban short selling, those seem to be the two sort of crutches that people go to whenever stock prices go down. Fortunately, the policymakers chose not to go in that direction. And at the same time this was all happening, we had people like Citadel Securities going to work from home. We had the New York Stock Exchange closing its trading floor, but remain opening for the first time in the 200-plus year history of the NYSE. And Citadel is one of the largest designated market makers, the New York Stock Exchange. And to Barbara's point, the markets continued on, seemingly without any problems. Give us your perspective on how crazy that was at that time, and what you all did to ensure that the markets were volatile but not broken.
Yeah, so I mean, talking about the equity markets, average daily volume in March rose to 15.6 billion shares, as compared to 7.5 billion in March of 2019. So we're looking at a market where there's over twice as much activity going on. And as I noted earlier, I think it's the investment in technology, it's the investment in automation that allowed the equity markets to continue to be efficiently intermediated, even in the midst of a lot of volatility, fundamentally driven repricing event on the back of the COVID-19 pandemic. And so, I think those markets perform admirably. And, we touched on some of the market safeguards that were put in place. So the market-wide circuit breakers, limit up, limit down, the alternative uptick rule. These safeguards were built into the fabric of the system, and so they worked largely as designed. And that allowed, I think, policymakers to step back and say, we need the markets to stay open. They are performing a vital role in terms of price discovery, allowing market participants to transfer and hedge risk, allowing both investors, private and public sector entities, to access cash and secure financing. So policymakers, I think, in the United States wisely were able to look at the stability and resiliency of the market and commit to keeping it open, and avoided ad hoc or knee-jerk reactions that I think in other jurisdictions we saw disrupt the smooth and efficient functioning of markets. So I think the investments that we have made pay dividends in our U.S. equity markets.
Jeff, let me follow up with that with you, right? So policymakers in the U.S. are getting good marks from Stephen and other folks from not closing the market, not banning short selling, not doing some things. But in fact, the regulatory agencies were very, very busy. I mentioned your previous role. You were at the SEC at the time, and you were making changes on the fly to adapt to the new dynamic situation that was going on, approving rule changes for the New York Stock Exchange to move to fully electronic trading, approving temporary rule changes for flexibility and for funds for their net asset value, and a number of other things. Give us an insider view in terms of what was going on at the SEC at the time, and in terms of what was the overall objective to all the policies that you implemented?
So first, one large reflection in terms of a job very well done. It underscores the importance of the old saying, personnel is policy, just in terms of, and I'm obviously talking my book here, and these are all my friends, but you couldn't have had a better set of leaders when you think about it. You have Jay Clayton as the SEC chair, a markets person. You have Brett Redfern running the Division of Trading and Markets. You have other very strong leaders within trading and markets, including David Saltiel and others. So I think the first thing to point out is we really had the right set of personnel that was perfect for this time to really understand what was going on, to think clearly and very collaboratively. So that's the first thing I'll say. The second thing I think there was, and this is just a compliment to the industry, to Stephen, Barbara, their firms, and many other firms, there was actually a very helpful open dialogue between what I observed between the public sector and the private sector of Wall Street, identifying issues, working collaboratively, thinking through ideas, whether it be if tailored regulatory relief was needed, and obviously, of course, thinking through the different facilities that the Fed and Treasury set up. I think it was a very collaborative and constructive process, and I think that's just a testament to the people involved. Those are some of my main reflections on that, Mike.
Yeah, I totally agree with you on the collaborative sense. I mean, that was one thing that Chairman Jay Clayton has really tried to do coming in as chairman of the SEC, was move away from more of the confrontational aspect with industry and trying to be more collaborative and find solutions. Because there are, people like Stephen and Barbara and a number of other folks in the industry actually want to get to a place on this and view their thoughts on that. Darrell, let me go back to you. We've talked about clearinghouses and the importance of them, and you were a big proponent of them for derivatives market. I remember talking to you when I was working on the Hill and at the SEC on these issues. But they create a new too big to fail institution, right? And so people worry about them. Any concerns about how the clearinghouses performed in this crisis? We did have the failure of one clearing member in the future market. I believe it was the CME. Any concerns about clearinghouses or any lessons learned from this crisis?
Well, of course, there are always concerns when you concentrate that much risk at one node in the financial system, and that's why it's paramount that a clearinghouse, let's say, as I've suggested, a clearinghouse for the Treasury market in a broad sense, it would definitely be too big to fail. On the other hand, we don't talk. I mean, for example, when you asked Stephen a moment ago what worked in exchange markets, we don't even think about the fact that in exchange markets, you don't need to worry about settlement. The National Securities Clearing Corporation settles virtually 100% of trading in the equities market, and that amount of risk that's cleared in the equities market is huge. Just take one security, the Spider S&P 500. The daily settlement risk that's cleared in that one security on the equities market is twice what would need to be cleared if you cleared the most actively traded and highest risk in terms of settlement U.S. Treasury security, the 10-year. So yeah, when you concentrate all the settlement risk into a large central counterparty, it needs to be heavily regulated. It is too big to fail. It has to have proper liquidity commitments from its clearing members, capital commitments from its clearing members and the clearinghouse. And to be realistic, for the Treasury market, in a last resort, the Fed might need, if all of the liquidity commitments of clearing members are exhausted in the most extreme tail events, the Fed might need to come in intraday and accept Treasury collateral for liquidity purposes, which is the natural role of a central bank. With all of the safeguards that we already have for highly regulated clearinghouses, the largest and most systemic ones, including the ones for the swap market that we've discussed, it's definitely worthwhile. I'd mention one more thing. It's not as though you're scraping up all the risk that exists in the bilateral market and stacking it in one spot so that it's the same amount of risk. When you centrally clear a market like the swaps market or the Treasury market, through the netting down of purchases and sales, you're reducing the amount of risk that needs to be settled. Because in the bilateral market, you have circles of exposures where one is buying and selling at the same time. And when you novate those two trades, a buy and a sell, to the central counterparty, you're only up for the net difference between the two. So the total amount of risk goes down quite a lot. Altogether, it's a much safer arrangement than what we currently have in the Treasury market. And I think it's something that the official sector should look very carefully into.
Yeah, so I want to follow up on this, the natural role of the central bank to be the lender of last resort in some of these markets. So the Federal Reserve, as I mentioned, has taken that to a new level in a number of different markets. They've opened up their playbook again from the global financial crisis and across a number of asset classes. And I'd love to get everyone's thoughts on this. I have some questions related to why it was important for them to do it. Are there any concerns about the Fed stepping in? Are there any moral hazard problems? And we actually have a great question from the audience. Somebody wants to know, to the extent the Fed and Treasury are involved in these markets, to what extent is there a crowding out concern that's going on here, and the market price being provided as providing price discovery and those sorts of things. So Darrell, let me start with you, and then we'll go to Stephen and Barbara on this question.
Well, I think there is, Mike, there is moral hazard when you don't improve the market structure and rely on the Fed to swoop in and rescue the market. There's moral hazard because, first of all, there's a tendency among market participants to believe that if prices become very volatile and the market becomes dysfunctional, that they will nevertheless be okay because the Fed is going to rescue the market. And that only encourages excessive risk-taking. It's also the case that market participants are less inclined to invest in better market structure, invest in central clearing, because they know that the Fed has their back when a crisis comes. And the Fed should have their back when a crisis comes. But I think the entire official sector should try to wean the market off of that reliance on Fed rescues and be able to better manage. Even with improved market structure, the Fed will need to be there in the very most extreme cases. But if you look forward in the next years, as Stephen mentioned, the size of the Treasury market is growing by leaps and bounds, and it will take smaller and smaller surges of demands for liquidity to overwhelm the current market structure, and the Fed will need to step in more and more often. And that sort of moral hazard, it's in my view, it's not a good trade-off. It also creates a situation in which during a crisis, you don't have good price discovery. You don't know what the true Treasury fundamental yield curve is because the Fed has basically set the price. And so for setting the prices, appropriate prices for bonds, equities, and other financial instruments around the world, you're losing some degree of price transparency when the Fed has to come in and reset the market. So for all these reasons, I think the central bank needs to be there in the last resort, but it needs to reduce the number of cases in which that happens.
Yeah, Barbara, let me come to you on that. So, the Fed has opened, some new facilities they've never done before in corporate bonds and municipal bonds. But in the commercial paper market, it's like deja vu all over again, right? You have the commercial paper facility and the money market liquidity facility. What's your view on these facilities?
Right. So first I would look at the Fed programs and I would bucket them in three categories. There's the outright purchase programs, so treasuries and mortgage backs, where they intervened very quickly and gave some relief to the bank balance sheet problem. Second would be the primary issuance facilities. And keep in mind, as the market became quite dislocated, a lot of issuers were not able to come to market, and there was concern both at the corporate level and the municipal level that they needed to be able to fund themselves, whether it was short-term commercial paper or it was longer-term bonds. But in all of those markets, they felt that having a primary facility would enable the issuers to have sources of funding. Now, what's interesting in that case is once those programs were announced, they had the effect of calming the markets so much that we actually saw very little uptake of the primary programs, and we saw instead huge volumes of new issuance, especially in corporate investment grade bonds, and the data is quite stunning. The third category is those secondary market purchase programs. And those also quite interesting, whether you saw take up or not. The first couple of things that came out, one was for commercial paper, but it didn't give the banks any relief on their balance sheet, and it really didn't have a huge impact. It wasn't until they put out what we call a balance sheet neutral program, where the banks could buy commercial paper from a money fund and use it to pledge to the Fed, and that didn't affect their capital or their liquidity ratios. That was the key that unlocked what was a very frozen market, and I think a very important insight as you look forward. The other thing I would mention is when we look at what's the solution going forward, I think you're right to be concerned about moral hazard, and you want to reduce the chance that the Fed needs to come in this, certainly in this kind of way, ever again. And I think that has three pillars to it. First is to look really again at the bank regulation and how can banks act in a counter-cyclical way in a crisis. Today, they are relatively pro-cyclical in harboring liquidity rather than using that liquidity. The second is the market structure. We've spent a lot of time talking about that today. But for example, in commercial paper markets, it would make sense to have central clearing versus what we have now, which I call parallel monopolies, where each commercial paper issuer is tied to one or a very small number of banks. As a buyer, you buy it from that institution, and you can only sell it back to the institution you bought it from. That's not a market. That's something very different than a market. So we would like to see some kind of all-to-all, maybe through central clearing. Maybe there's another electronic trading mechanism. But there does need to be develop a market for commercial paper, especially given the bank balance sheet situation. And then that third pillar is to look, as I mentioned earlier, at the asset management products themselves, whether it's decoupling the 30% test from the board meeting, or it's in the longer term bonds, adding swing pricing. But I think there is room for improvement in all three of those pillars so that we can reduce that moral hazard risk and the chance of the Fed ever having to come back in.
Stephen, let me ask you to follow up on that, right? So Barbara's given some very interesting recommendations for policymakers, and given the experience that we've had here, you, as I mentioned, Citadel operates in a number of these markets. What sort of perspective can you add to that?
Yeah, so I think it's interesting. We spent a lot of the beginning of the call talking about kind of the resiliency of the big bank sector and post-crisis reforms there, and then we've spent time here talking about the Fed's intervention. But again, as we look across the capital markets, the equities markets, the futures markets, the options markets were efficiently intermediated without a need, without bank intervention, without central bank intervention, and so those are some of the lessons that I think we need to take from this. And I think the focus on market structure here is well deserved, because there are steps we can take to make the markets be able to be intermediated much more effectively and much more efficiently with a greater diversity of participation that I think will diminish over-reliance on either the big banks or central banks. I think obviously the Fed's going to have a central role to play in the U.S. Treasury markets for a variety of reasons, including the execution of monetary policy. But I think we can continue to take steps that make markets more accessible, diversify participation, which will ultimately make them more resilient going forward in the face of any future strains or dislocations.
I think, Jeff, we have a great question from the audience that I think I would direct to you. So Jeff, one of the questions from the audience was, to what extent has the rise in retail investing contributed to the volatility in the equity market. And I would phrase it slightly differently and maybe ask some related questions to that, right? So do we know there's been a huge increase in direct retail investing? We've always had retail investing, through institutions like BlackRock and other asset managers. Now we're seeing more direct retail trading going on in the market. Some folks call it the Robin Hood effect, but there's certainly other brokers who have gone to zero commissions, made it much easier to trade. From a regulatory perspective, with your hat on at Treasury, thinking about the financial stability type issues related to that, and then also with the investor protection issues hat on from your former SEC role. To what extent have you looked at, are retail investors causing the volatility? Are they being victims of the volatility? Give us your insights there.
That's a great question. So a couple thoughts. First, in terms of there's certainly a lot of positives. It's consistent with the overall theme of sort of the democratization of the markets, and increased retail involvement and focus is good. In terms of the investor protection angle, we always want to think through, what are the sales practices issues? What are, what is changing, and whether it be SEC rules, FINRA rules applicable to broker dealers, do those need to in turn be modernized with the advent of trading technology on people's iPhones? Thinking just all about the sales practices issues. In terms of the larger point raised, Mike, in terms of thinking about costs have been squeezed down, competition is very good. But thinking through what are the collateral consequences of that as you think about interconnections, does that cause businesses to put pressures on other segments of the business? What is that doing in terms of incentives in the market, payment for order flow arrangements, and elsewise? So I think you want to think about it very holistically, recognizing that there are some good aspects of, again, wringing out and squeezing down the costs on investors, all very positive, but thinking broadly in terms of what are the other implications on that. I think all in all, it's a positive development, but one that the regulatory community needs to really focus on and scrutinize closely.
All right, great. So we only have just a few more minutes left. I'd like to do one final round of a quick lightning round for folks. You've given policymakers a number of great ideas in terms of lessons learned and where we should go next. Let me start with Darrell, then we'll go to Stephen and Barbara. In terms of if policymakers were to focus on just one thing, what's the most urgent thing that they should be focusing on over the next, say, 3 to 6 months of the year? And then end with Jeff, in terms of, as a policymaker, what can industry and academics do to help you in your job? So, Darrell?
Well, not surprisingly, given the amount of time we've devoted to market structure, I think the official sector should take a deep dive, do a serious quantitative study of market structure and whether it's adequate to meet the growing demands for liquidity, especially with increases in the sizes of our bond markets, or whether an improvement in market structure may be necessary. I would start there. I would also come back to some of the points that have been made about improvements in price transparency. Jeff pointed out that the trace FINRA data for treasuries is providing improved transparency. And as Stephen said, it would be very helpful to roll out that price transparency to market participants. We've seen a lot of success there in the corporate bond market. So those are the two areas in which I think, in terms of financial regulation and the performance of financial markets, that I would look to next.
Stephen, what would you recommend policymakers really laser-like focus on?
I'm going to pick up on Darrell's point, and also I think you asked what can be done in the near to medium term, and I think that the post trade transparency is key. I think it's a fairly low hanging fruit in the Treasury market, given that we're already collecting the data. It's not just a U.S. problem; it's a global issue too. So MiFID II in Europe didn't deliver the transparency that was hoped for in the European markets, but there's ready fixes on the table there, including establishing a post trade consolidated tape for the bond and derivatives markets in Europe. And then we have other asset classes like FX, where there's just no consistent source of post-trade data. So the value we've seen in the corporate bond market, the equities market, the futures market, the municipal bond market from having post-trade transparency is one that is very straightforward to replicate in other asset classes as well.
Yeah, Barbara, you've already given us your sort of top three different buckets. Looking at countercyclical bank regulation, market changes in market structure, and changes to asset management and liquidity. If you were to pick one, what's the most important?
So I'm going to cheat. I can't pick one. I'm going to give a plug. We've written a whole series of white papers called Lessons from COVID-19. They're available on our website. Just Google them. They're chock full of what actually happened. Let's make sure whatever comes out is very much data-driven, not speculative, not instinct. I think it's very interconnected, and we can't just pick one thing and have a magic wand. We really have to look holistically and start by gathering the data and then figuring out how to move forward. Thank you.
Okay, and then Jeff, just 30 seconds in terms of from where you sit, how can industry be helpful in addition to these white papers, and also what should academics be looking at in terms of what could be helpful for you?
I think two things I'll say quickly. One, continued focus on cyber. Before going into this year, I would have said that's the biggest threat, the biggest risk. We need to all keep our eye on cyber issues, both in the industry and the public sector. And then secondly, housing finance. That system is in need of serious reform. So I think, continued thoughts about that. There's excellent work underway at the FHFA. The FSOC just completed an activities-based review of that market. And so those issues, I think, require continued focus going forward.
Thanks, Jeff. And I want to take this time to thank all of our panelists. I mentioned at the beginning, for more than a decade, policymakers in Washington, D.C., whether it's the administration, in the halls of Congress, financial regulators, have reached out to all four of our panelists, some from Jeff on the inside and on the outside, and you all have been very generous with your time. You've given policymakers a lot of good recommendations for market events in the past, and today's discussion show that you have a lot of great recommendations for policymakers going forward. So with that, I want to thank our panelists one last time and thank our audience for joining us today.
Thank you, Mike.
Thanks, Mike.
Thanks, Mike.